Good morning, afternoon, and evening. My name is Alexander William Elliott. I am President and CEO of A.W. Elliott and Associates. We are a comprehensive financial and tax advisory firm, which means we are financial advisors and tax advisors. So a lot of our clients like the fact that we do both. Anyway, welcome back. This is part five. We're going to talk about one of my favorite subjects, long, not long, come on, tax planning and tax strategies. Okay, we're gonna talk about some things to help you reduce your tax liability. Again, this is all part of our uh, generational wealth and financial literacy series. Okay, our next series or part to be part six, I believe. It's going to be on another one of my favorite subjects: investment planning, tax planning, not investment planning, and investment strategies. Okay, so we've talked about short and long-term goals. Okay, uh, one of the ways to reduce your tax liability is to buy a home. I have some clients that they're making 80, 90, $100,000. They're not or more. I've had some more that own no property. They have no write-offs. Okay, no write-offs equals more money you pay in taxes. Okay, especially at that income level. So one of the first things you want to do is to buy a home, because if you're renting, you can't write that money off. But if you own the home, obviously you have the mortgage interest that you can write off, and property taxes, and that's going to add to, because you want to itemize your deductions. Okay, there is what they call a standard deduction, okay, which everybody gets, whether you're single, married, but you want to go beyond that. When you itemize, deduct your expenses on your taxes, that reduces your tax liability. Okay, so you want to do that. You want to get to the point where you can itemize your deductions, and one way to do that is through buying a home. You could be rental property. You could own some laundry mats, and we'll get into the business aspect. I think I'm going to do a part B for business owners. Okay, so that's a whole nother segment, which those things will definitely put you in a better tax situation. Okay, so buying property. So your goal is to pay, and I forgot to mention this, because the IRS code allows you legitimately to write off whatever is in the tax code, and you qualify for that deduction, you get to write it off. Uh, I've worked with some people currently and in the past that, well, I don't want to do this because I don't want to get a notice from the IRS, this, that, and the other. And I'm like, well, you are entitled to, and if for some reason they do question it, you have your receipts. That's important. Your bookkeeping, record keeping. Okay, you have your receipts. So as long as you are entitled to it, there's no problem. And as a tax advisor, I guarantee I represent, if for some reason you get a letter from the IRS, I'll take care of that for you, as long as it's something that has to do with the tax return that I prepared. But I'm kind of glad to say I've never had a client over the 30 years or so that I've been doing tax planning or as a tax advisor that has been audited, okay, on a return that I've done. Okay. And even if you get audited, it doesn't mean that you owe the money. IRS makes mistakes. They could send out a letter and come to find out you don't owe any money. So, get a letter from IRS, don't panic. You need to hire a financial advisor, a tax advisor, someone that can represent you in front of the IRS. and that has the expertise and knowledge to handle that situation. Okay, so that's what you want to do. The other, part 5A or B, wherever I'm going to call it, we're going to talk to business owners, solo entrepreneurs, people with side hustles. Okay, if you own a laundromat or a vending machine business, we're going to get into the tax aspects of that. Those are when you're in business, it opens up a whole new avenue of write-offs that you can write off. That's one of the best possible positions to be in, as far as writing off certain expenses. Also, if you have a 401k at work, you want to max out on that. Okay, that's going to reduce your tax liability. At the same time, you're saving tax-free money. Also, even though you have a 401k, you can contribute into an IRA or a Roth IRA. That again will continue to lower your tax liability. And these are what you call qualified plans, where the government is kind of giving you a tax break for saving money. Now, when you take the money out, you pay taxes, but there's a strategy. I have a strategy for that. Okay, where you can pay very little. I wouldn't say no tax. Sometimes no taxes, or very little tax on that money when you take it out, depending on what you use it for. Okay, so the 401ks, IRA, you want to maximize those. Like with a 401k, a lot of times the employer will match or contribute. I mean, that's free money. How do you pass that? What? No, so you max out the employer contribution, bam. Okay, so those are the things you need to do to reduce your tax liability. So the next one is going to be on business owners. Okay, so I decided to split this in two segments. Okay. Anyway, you know my motto: make some money, save some money, have a blessed and wonderful day. I'll see you at the next one.